Hello everybody, welcome back to another valuation investing video, and today in this video I'm be going over some of the most popular stocks and determining whether or not these stocks are undervalued, and I'm be ranking these on a tier list that I've made. So we're going to be ranking them based off the valuation and also my willingness to be able to pay for this company. So it's kind of going to be also based off their fundamentals, but mainly based on their valuations. So with that being said, let's get into this rankings, and I'm going to be using my intrinsic value calculator in order to calculate whether or not I believe these companies are trading at a fair value, or we should be buying the stock today or even selling the stock. So let's get into these companies. So the first stock that I'm going to be looking at is going to be Google stock, in which, just a disclaimer, this is my largest position in my portfolio, so just keep that in mind. But I'm going to do a fair analysis to determine whether or not today, if this stock is worth a buy. And if you haven't seen Google stock, the stock is up about 50% over the past few months. So this stock has seen a huge rise in the recent months, and this is actually the best performing Mag 7 stock this year. So this is a very good performer in the past few months. So with that being said, let's go over to my valuation investing platform and let's go into the intrinsic value calculator. But first, I'm going to be taking a look at the 7-step stock analysis for Google to give us a good basis for the fundamentals of Google and to see how good they are. And as we can see here, we get 7 out of the 7 key metrics that I like to look at as check marks. Forward P ratio is less than 30, so it's trading at a reasonable valuation. Return on invested capital looks pretty good. Revenue growth, EPS growth, both double digits, so that's good. Shares outstanding are decreasing pretty good at about 2.5%, which gives us a greater return as investors and gives us more percentage of the company. Also, the debt to free cash flow is pretty good at 0.8, so that's also really good. They pay off all their debt in a less than 1 year, so that's good. Also, the future revenue growth is expected to be about 13% with Google. So with that being said, let's go to my intrinsic value calculator to get a fair value price for Google. And first, let's do the bear case for the revenue growth. So this is for the next 5 years. And I think for Google, we can put a revenue growth. Honestly, I think a fair revenue growth for Google would be 8%. I think they can grow. This is basically assuming that they decelerate growth, but I honestly think that they can still continue to grow fast. They're still growing at 11 to 13% each year, so that's still pretty low for the bear case. Base case, I think they could grow about 10.5%. And bullish case, with that being said, I think they could grow probably, let's do 13%. Now, for the bear case future profit margin, right now their profit margin's right at 30%. And I think for the bear case, it's going to be at about 28. Let's say it starts to decrease as AI takes market share from Google, bear case. So let's just put 28%. But for the base case, I think Google could have a 31, 32 P ratio. Let's do 32. I think AI could make Google even more efficient in the future. Also, bull case, let's put a 36% profit margin. Now, for the future PE ratio, I think bear case, I think a company growing 8% like Google, they have a pretty decent moat, but it is slightly deteriorating due to AI concerns. But I think a PE ratio of 20 would be fair. Base case, I think a P ratio of 24. Bullish case, 28. Now, for the shares outstanding, I think bear case, they say they buy back at 2%. Let's do base case, say they buy back at 2.5%, and then bullish case, say they buy back at 3%. And with this being said, calculating the intrinsic value, right here, we get a base case projected price of $436 in the next 5 years, meaning base case, I think you can make 12% on your return if you bought it today. So this looks very good for Google stock. And with that being said, me personally, I think this is very telling of Google stock and how well Google has done over the past few years and how underappreciated Google stock has been in the past few years until as of late, because of that recent court ruling that really helped the stock continue to go higher. So with that being said, for Google stock, I'm between putting it in the buy now category or undervalued, because me personally right now, I'm not necessarily buying, but I'm very close to buying some. So actually, I'm going to put it in the buy now category. I think if we get in the 230s or less for Google, I might add a few more shares to my position. So I'm going to put Google in the buy now category. Now, for the next stock I'm going to be looking at, we have Microsoft. So Microsoft is one of the largest companies right now. Microsoft continues to go higher. It is basically the staple for fundamentals, good fundamentals. So let's get into Microsoft stock. So if we go ahead and type in Microsoft into my stock analysis, let's get the 7-step stock analysis for Microsoft. As we see here, we get 6 out of the 7 key metrics for Microsoft. The only bad metric we have is the forward P ratio, which it's a little bit high. So the valuation could potentially be a little much for Microsoft. But just because a P ratio is high doesn't mean that we shouldn't be buying the company. We have to get two sides of the story. First, we need the valuation, then we need the growth rates, because that's what makes the two really worth something. Because you can't just buy a company because the P ratio is low, or you can't just buy a company because the growth rate is very high. You have to put the two together to get a good valuation. And then all the rest are good check marks. So Microsoft's doing pretty good. And with that being said, let's go to the intrinsic value calculator. For Microsoft, I honestly think they're going to be growing pretty similar to Google, maybe a little bit faster. Bear case, I'm going to put 8%. Base case, I actually think Microsoft will grow about 11%. In bullish case, I'm going to put Microsoft will grow 14% in the future. Now, for the future profit margin, right now their profit margin, if we go up here, we can see the profit margin is at 36%. So with that being said, I think a good future profit margin on the bear case would be 35%, because say it slightly declines a little bit, maybe it gets to 35%, but truly I think base case this company could have a 38% profit margin. The reason for this is I think with ChatGPT, OpenAI, I think they're going to increasingly get more efficient. Also with Microsoft Azure really starting to grow, that's going to increase their profitability. Now for the bullish case, I think we have a 41% profit margin. And future P ratio, I think bear case, I think Microsoft deserves a slightly higher premium than Google. So let's put a 22 P ratio. And for the base case, I'm actually going to put 26, bullish case 30. Now for the shares outstanding, they're not buying back a whole lot. So I think bear case, say they buy back, or say they keep it constant, and base case, say they buy back at 0.5%, and then bullish case, say they buy back at 1%. With this being said, if we calculate the intrinsic value, we get an annual return of about 5% from today's price for the base case. Bullish case about 13%. So if I wanted to get a 10% return, I would want to be paying less than $400. And with that being said, with about a 5% annual return, let's go over to the tier ranking. So going over to the tier ranking for Microsoft, honestly, I'm going to put this in fair valued. I know only a 5% return seems very low. However, I will say that Microsoft probably does deserve a premium. So honestly, I'm just going to put Microsoft in the fair valued. Do I think it's necessarily overvalued? Probably not. So I think it's on the borderline between fair valued and overvalued, but let's just put it at fair valued for now. Because of the high qualityness of Microsoft, I'd be willing to pay a lot higher for a company like Microsoft. So let's put it at fair valued. If it was truly in the overvalued category, I think we would have to be seeing very low single digit returns in the future, but I think you can make about 5 to 8% in Microsoft in the future if you bought it today. So I don't think it's too bad right now. Now for the next company, we have Meta stock, in which Meta has been one of the craziest stories since 2022. The stock was at $80, but now the stock is at about $750 per share. And I actually like to compare Meta to Google right now, because Google is basically what Meta is going to do, what Meta did in the past. That's what I believe with Google. Google was trading at a very cheap valuation like Meta. Meta was trading at an insanely cheap valuation in the past, but now it's really started to have multiple expansion. So with that being said, let's get into Meta stock. Taking a look at Meta stock here, we get 7 out of the 7 key metrics. So this looks good for Meta, and very good fundamentals from Meta. The forward P ratio is almost an X at 29. So just keep in mind the valuation is a bit elevated, but it's still pretty good. All these growth numbers are very good. EPS growth 33%, revenue growth 12%. Everything looks very good for Meta. If we go over to the financial history charts here that I've created, the revenue history looks very good. It was stagnant a little bit back in 2022, which is why the stock really fell. And taking a look at the net income, this was why the stock was falling. About it basically went down the net income 50%, and that's why the stock also fell a bunch. But everything else looks very good for Meta, especially in the past 2 or 3 years. So with that being said, let's go to my intrinsic value calculator. For the bear case, I'm also going to keep this at 8%, but I see a bit more bullishness in Meta. Let's put a 12% base case growth rate. Bullish case, I think Meta could grow 16%. I think Meta is going to be one of the faster growing companies in the future in the big tech area. Maybe not besides Nvidia, but I think Meta is one of the better ones in the future. Now for the future profit margin, right now their profit margin is at about 40%. So with the future profit margin bear case, I'm going to put a 38% profit margin. Base case, I'm going to put 41%, and bullish case, I'm going to put a 44% profit margin. I think they're just going to slightly increase in the future. I think they're going to slightly get more efficient. Now, bear case, I think a P ratio of about 20, I'll do 20 because I think Meta is slightly worse off than Microsoft based on the whole company as a whole. The only reason I say that is because companies like Meta and Google compared to Microsoft is a little bit more not well predicted in the future, I guess you could say. It's hard to predict what they're going to do in the future compared to Microsoft. It's slightly harder just because of the amount of advertising is more consumer discretionary, and Microsoft is a bit more of a staple compared to these companies. So I think they deserve a slightly lower valuation than, say, Microsoft. So that's why I'm going to put a 20p ratio. But now for the base case, I think growing at 12%, they deserve a 25p ratio. Bull case, I think 30p ratio is fair. Now for the shares outstanding, let's go back and see how much they're buying back. They're buying back at about 2.5% each year, but I'm pretty sure it's starting to slow down a little bit because they really bought back a lot back in 2022. So yeah. So let's say they buy back at about 2%. So let's go bear case. Let's say they buy back 1%. Base case, let's do they buy back 2%, and then bullish case 3%. So with that being said, looking at our intrinsic values, I am fairly surprised, but not really, because I'm very tempted in buying Meta stock today. Right now, we have an annual return of almost 14% with Meta. And this is pretty conservative numbers, to be honest, I personally believe, because they just grew at near 20% revenue growth in the past quarter, year over year. So I think this is actually pretty close to me buying, and I need to do some more research into Meta. So let's get into the tier ranking. So with Meta stock, I believe Meta right now is also a buy now with Google. I honestly think Meta is more of a buy than Google right now, and I think Meta might be the best big tech company to be buying right now, right in front of Google. So with that being said, I need to do more research on Meta and might make a video on Meta in the future, because I truly think Meta could be a good buy today and you can make a good return. So with that being said, the next company we have here is ASML. ASML, if you didn't know, they make EUV lithography machines, and those machines have to be used by semiconductors. So every single semiconductor manufacturer has to own an ASML machine in order to basically laser and engrave the patterns into chips, which will overall help these chips become more efficient and powerful. And every single company like Intel, Taiwan Semiconductor, Samsung has to have these ASML machines. So with that being said, I believe ASML is a very good company and has a very big moat, because they're the only company that makes these machines. And what is the future of basically Earth? AI. What do they need to have to create AI and to make it more efficient? More chips, and ASML is the front runner in these machine areas. So with that being said, ASML, let's get into ASML stock. Taking a look at ASML, as we can see here, we get 6 out of the 7 key metrics. So very similar to all these companies, the only X's we've had so far is the Ford P ratio, showing a slight high valuation in these companies. So with that being said, Ford P ratio at 36, a bit high, but everything else looks good. Return on invested capital, good. All the growth numbers look good here. Shares outstanding going down, and the debt to free cash flow is very low for ASML. So all this looks good for ASML. So let's go to the intrinsic value calculator. So bear case, I think bear case, ASML will grow 9% in the future. Base case, I think ASML could grow 13%. Bullish case, I'm going to put a 17% growth rate. I think ASML has a very bright future in their growth. As these companies demand more of their machines, they're going to continue this growth rate at a very fast pace. Now, for the future profit margin, right now their profit margin, let's go look here at about 29% profit margin. So with that being said, for the future profit margin, I think bear case, this company gets basically what it is today. I see this company increasing their profit margins in the future. Base case 31%, bullish case 33%. Because they have such high pricing power, because they're the only company that makes these machines, I think that they can continue to charge more and more for their machines. Now, for the bear case, a company like this growing 9%, I think deserves a 22 PE ratio. Honestly, maybe even a 23 PE ratio because of the moat of this company. Now, base case, I think ASML probably deserves a very high 20s PE ratio. So I think a 28 PE ratio could be fair. In bullish case, I think this company deserves a 33 PE ratio. Now, for the shares outstanding, this company's been buying back at about 1 or 0.5%. So I think bear case, they buy back at 0.5%. So if we put 0.5% here, I think they're going to continue to buy back, but I don't think they're going to be buying back huge amounts. Now, base case 1% and bullish case, let's do 2%. Actually, no, 1.5%, negative 1.5%. So with that being said, if we calculate the intrinsic value, I get an annual return of ASML actually at 10.9%. So this looks pretty good for ASML still. I might be a little bit too aggressive with these numbers, honestly. So let's just say a 12% and 27 PE ratio. I still get a 9% return. So honestly, I think ASML looks good right now. I said in the past, if it gets under 800, I would continue to buy. But honestly, if it got under 850, I might be considering buying more. So this is my actually second biggest position. So let's go over to the tier ranking. Now for the tier ranking, I honestly think ASML should go into the undervalued category. Do I think it's necessarily a buy right this second? I wouldn't say it's a buy right now. However, I do think it is undervalued. If I didn't own this company, I would potentially start adding a position in this company, but I do think it could be slightly elevated in valuation, but I still think it's a great company that a lot of people should own. So now with the next company, we have Amazon stock. So Amazon, as we know, Amazon is one of the biggest basically retailers and shipping companies, but that's not where Amazon makes most of their money. If you didn't know, Amazon makes most of their money from AWS, which is their cloud business, and this is the biggest cloud business on the market. So AWS is a big player, and this is how they're actually pretty profitable, even with their shipping and physical retail business. So let's go over to our calculations. Taking a look here at Amazon, this is one of the worst fundamentals so far with a 4 out of the 7 of my 7-step stock analysis. So taking a look here, we get the forward PE ratio 36, so slightly elevated. The return on invested capital looks pretty good. Revenue growth looks pretty good. EPS growth looks very good, but that is over exaggerated only because they were actually negative. They had a negative EPS, I think, back in 2022. I think it was almost negative. I don't think it was necessarily negative, but they almost lost money in 2022. I'm not exactly sure if it was negative, but we can go over here to the charts and see if it was, and it actually was negative back then. So that is going to be slightly skewed for the growth rate, but they're still growing very fast, so don't get that wrong. Now, the only thing I don't like about Amazon is the shares outstanding slightly increasing. The reason I don't like that is because if a company dilutes you, you're actually going to own less of the company, and I'd rather see them buying back shares. But if they think they can get a better return, say in maybe making robots or something like that, then it would be worth it to sell shares to generate more money to reinvest. So it's not terrible, but I would honestly like them to buy back some shares. Debt to free cash flow a little bit high. Makes sense with all the buildings they have for the Amazon fulfillment centers and the stuff like that. So keep that in mind. Also, future revenue growth of 13%. So they're still expected to grow pretty fast. I don't think 13% is base case scenario. I think that might be bull case. But let's get to Amazon, and right here for the bearish case, I think Amazon will grow about 8%. Base case, I think they grow 10%, and bullish case 12%. So I think Amazon in the future, honestly, in the short term, Amazon might struggle a little bit due to their lack of innovation with AI. Not lack of innovation, but they're not really leading in the AI race. But I do have to say, I think in the long term, Amazon could really benefit from robots and artificial intelligence. As they make robots and say self-driving vehicles and stuff like that, I believe that Amazon could really up their profit margins. So in the next 5 years, right now their profit margin is at 10.5%. I truly believe bear case, it still gets up to 11%. Honestly, base case, I might be more bullish here. Let's put 14%. In bullish case, I honestly think that their profit margin could get to 17%. The reason I believe this is as they start to integrate more robots, they will have less people working for them, so they don't have to continuously pay their employees. So as they reduce the employee number, they can continue to increase that profit margin and spend less money on employees. So I think they can get more efficient in the future. Now for the future PE ratio for Amazon, I think they deserve probably a 22 PE ratio for the bearish case. Base case, I think this company probably deserves, let's do 26 PE ratio. I think Amazon's a great company. You should be paying a lot for this company. And bullish case 30. Now for the shares outstanding, I think they're going to increase 1.5%. Base case, say they increase it at 0.5%, and bullish case, say they somehow decrease at 0.5%. Even though it's not likely, you never know in the future. So with that being said, let's take a look at our values. As we see here, base case, we get 10.2% annual return with Amazon. So honestly, it looks pretty good, but I would say the P ratio could be slightly high and the profit margin and the revenue growth. So if we just decrease this slightly, say we get 9% revenue growth and all this, 7% annual return, I think this company is either fair valued or undervalued. It's basically teetering on whether or not it's undervalued or fair valued. I would like to buy this company at around 180 or less, so keep that in mind. But nonetheless, I'm between undervalued and fair valued for Amazon because I think you would make about 7-ish% on Amazon. So honestly, I'm gonna put this in the fair valued category. I think Amazon's definitely at a better valuation than Microsoft though. I think Microsoft is close to the overvalued category, but I think Amazon would be a better investment as of today compared to Microsoft purely on valuation, but I do think Microsoft could be a better business to grow in the future. So now the next company I'm going to be looking at is another one of my holdings. This is going to be Visa stock. Not a lot of people cover Visa because it's kind of a boring company, slowly growing, but another misconception also with Visa, people believe that Visa takes on debt from people because they have to do with credit cards. However, if you didn't know, they're actually the middleman between the bank and the consumer. So Visa doesn't have to deal with any of that type of debt from, say, someone doesn't pay off their credit card and they don't have to pay debt. So they don't loan anything out to consumers through credit card debt. And actually Visa, all they basically offer is security between the bank and the consumer. So they just offer a service to ensure that the money gets from you to the banks. So that is what Visa does. And this is a very good company because it's basically a duopoly between Visa and MasterCard. So with that being said, let's get to the fundamentals. Taking a look at the fundamentals for Visa, we get 7 out of the 7 key metrics. This is why I own this company, because I think Visa is a great company. Forward P ratio of 26, so this is actually one of the lowest forward P ratios so far. Return on invested capital looks good, revenue growth looks good, EPS growth looks good. Everything looks very good for Visa. Visa is just an overall very consistent, good company, continuing to grow in everything. It's just a great company to potentially add to your portfolio. So let's go over to the intrinsic value calculator. But before I get into this, if you guys are enjoying this video, please subscribe, hit the like button. The road to 5K has started. I want to get to 5,000 definitely by the end of the year, so please subscribe. And also, if you want to go check out this valuation investing platform, all you have to do is go to the description, click on my Patreon. Once you join the Patreon, you get a 7-day 7-day free trial, so don't worry about paying for the first 7 days. You automatically get access to this stock analysis platform, and after that it's only $8 per month. It's the cheapest out there. I promise you, it's the cheapest valuation. Basically any stock analysis platform, I believe this is the cheapest out there, and I think it's one of the best. So if you guys want to go check it out, you can go get a free 7-day free trial with the link in the description. But let's get into Visa. So bear case, I think Visa will grow. We can do 8%. I think base case they'll grow 10%, and bullish case 12%. Now for the future profit margin, this company has a profit margin of 52%. This is one of the most efficient businesses out there. So bear case, I think we give them a 51% profit margin. Base case, I'm gonna put 54. Then bullish case, actually no, let's do base case 53, then bullish case let's do 55. I believe this company deserves a very high premium because of their profitability and good return on invested capital. Also the duopoly between them and MasterCard. Basically, there's no competition in this space, so I think they deserve a pretty good premium. Bear case, I think this company deserves a 23 P ratio. Base case, I think they deserve a 20. Let's do 26 PE ratio. Bullish case, I'm gonna do a 29 P ratio. And they've really been buying back a lot of shares, I'm pretty sure, over the past year mainly. Looking here, they really bought back a lot of shares over the past year, and even the past year, which doesn't calculate here yet since it's not the full year, they bought back an insane amount of shares. So I think they're going to continue to be buying back because they realize that they probably can't grow as fast as they used to, but buying back shares will really help the company. So I think bear case, they buy back 2%. Base case, let's do 2.5%, and then bullish case 3%. They've really been buying back, I think, at 4 to 5% over the past year over year. So I think that's fair. And with that being said, for Visa, I get an annual return of about 8% at today's price. If you want to get a greater than 10% return, you have to get it under $300. And if it ever gets under $300, I'm definitely going to be adding to my position. Right now, my average price is at $273, and it's my third largest position. I think Visa is a great company. I think they trade at a bit high valuation almost always. So if you ever see them dip down, I think it's a great time to buy. But right now, let's go over to the rankings. So with that being said, at the rankings, I think we have to put Visa into the fair valued category. I think Visa is at the fair value right now. I think you make about 8% return. That's about market average, 8 to 10%. So if a company's at anywhere from 7 to 10% return, that's for sure fair valued. But Microsoft I think, is the worst one here based on valuation, so keep that in mind. I think Amazon and Visa look good, but I really think Google and Meta could outperform the market in the future. Now, the next stock we're going to be looking at is Alibaba. This stock has had a huge run-up in stock price. It went from $80 and now it's at $180. Huge returns. If you didn't know what Alibaba is, it's kind of like the Amazon of China. So they're basically an online retailer, e-commerce business, but they also offer some other things like Alibaba Pay. They're also making their own chips, which is why I think the stock has really been rallying due to the buzzwords of AI or chips. That's why Alibaba is really rallying. Also because Alibaba has just really started to make a lot more money than they were previously thought of, so that's why the stock's doing well. So let's get into the valuation. Taking a look at Alibaba, we get 4 out of the 7 key metrics. The forward P ratio is pretty low at 18, but the other key things to look at aren't great. As we see here, 8.7% return on invested capital, revenue growth only 5%, but the EPS growth is very good. They recently had a really good net income year. If we go over to the financial charts, we can see this net income was insanely good in 2025. I wonder what the real reason for that is. I don't know, but let's go over back to the 7-step stock analysis. Shares outstanding, they really started to buy back a lot of shares recently, so that's good. Debt to free cash flow is non-applicable, so let's go over and see why that is. If we go over to the balance sheet, let's see. They have positive free cash flow, so I don't know why that is. Maybe because it's counting 2024 debt, maybe. I'm not sure why that's like that, but The debt situation still doesn't look bad at all for Alibaba. They have plenty of free cash flow to pay off all their debt right now. Also, the future revenue growth expected to be 2%. I think that's insanely low. That's probably not very accurate, but let's get to the intrinsic value calculator. For the intrinsic value calculator, I think bear case, this company will grow 4%. This company is pretty slow growing, but I think 4% could be very conservative. Now, base case, I think this company could grow 7 to 8%. I think we could put in 7, and let's do a 7.5%. Let's just go in the middle. Now, for the bullish case, I think this company will grow, let's say for the bullish case, we have this company grow at about 11%. Say their chips really help this company become more efficient in the future. Now, for the profit margin at 14 to 15% right now, I think bear case, this company gets a 14 profit margin. Base case, I'm going to put 16, bullish case 18. I think it's going to slightly increase in the future due to their chips and just them becoming more efficient. Now for the future P ratio, for the bearish case, a company growing only 4%. Also, this company is in China, so I think you automatically have to put a slightly more discount, and the only reason for that is just because of the concerns over the restrictions in China on businesses. So with that being said, for the future P ratio of the bear case, I honestly think a 13 P ratio could be fair. Base case, I'm going to put a 17 PE ratio. And now for the bullish case, growing at 11%, this company deserves a 21 PE ratio. Now for the buybacks, I think they're going to be buying back slower than they previously were. So I'm going to put 1%. Base case, I'm going to put 2%. Bullish case, let's do 3%. With that being said, right now, I think we can get about a 7.2% annual return with Alibaba at today's price. So with that being said, let's go and rank Alibaba. Looking at Alibaba here, I believe Alibaba is also in the fair valued category. So I think Alibaba is looking okay, but honestly, out of all these companies in the fair valued area, I would not be buying Alibaba. The only reason is because of the quality of Alibaba is slightly worse than these 3 other companies. So I'd rather be buying, say, Amazon and Visa, but that's just me. Now, for the next company I'm going to be looking at, we have FICO. I've made some videos on FICO. I said I was interested in it at a certain price under $1,300. However, the stock did not get quite there, got to about $1,350. So I did not quite pull the trigger on FICO. And if you didn't know what FICO is, it's basically just a mortgage, basically credit score. So that is the reason why I believe this company is great. If you're getting a mortgage, you have to basically use FICO, but not necessarily anymore, and that's why the stock was actually falling. This company had a very good monopoly where if a person was getting a mortgage in the US at least, you'd have to use FICO and get a credit score to assess your basically ability to pay off debt and just to get a loan. But now the recent administration actually did change it to where FICO, you don't have to use FICO now. You can use another company, which I don't fully remember the name here, but I know S&P Global and Equifax, I think Equifax does own it. I'm not sure the exact name of what it's called, but I know Equifax does own that. So with that being said, now FICO isn't the only mortgage score basically. So with that being said, their moat is potentially slightly deteriorating. So let's get into the valuation. Taking a look here at FICO, we get 5 out of the 7 key metrics, so not too bad at all. We get a forward P ratio though very high at 41, so that's not great. And the debt to free cash flow at 4.4, so a bit elevated debt compared to their free cash flow. This means they could pay off all their debt in about 4.5 years, so keep that in mind. But the revenue growth, EPS growth looks good, and they're buying back a bunch of shares at almost 4%. The only thing I don't like about FICO is they're raising a lot of debt in order to buy back shares. That's the thing I don't love about this company. I'd rather them not be buying back as much and say pay off some of their debt, but it's not too big of a worry to me. So going to the intrinsic value calculator, I think bear case this company will grow, I think about 8 to 9%. Let's do 9% revenue growth. Base case, I think this company could grow 13%. Bullish case, I'm going to put 17%. I think in the future, this company is going to be growing very well as more and more people start to get more mortgages, and also as they just have to be used. Now for the future profit margin, right now they're at a profit margin of about 32%. I think bear case, this company might have some price reductions due to the competition now with Equifax's basically brand in the mortgage lending area scoring. So with the profit margin, honestly, with it at 32, 33 right now, I think bear case we get down to 29. Base case, I think we get to 32. Bullish case, I think it does still increase to 35. But I think base case, we remain about where we are today. Now for the future P ratio, growing 9%, I think this company deserves about a 23 P ratio. Base case, I think for a company growing 13%, I think they deserve probably a 30 P ratio. And then for the bullish case, let's put a 37 P ratio. This might be a very high valuation for this company. This might be a very high valuation for FICO. So actually, maybe let's put a 20. Actually, I'm not sure. I think 30 could be decent for FICO just because of the moat they have. Now, bear case, I think they're going to buy back 2%, base case 3%, bullish case 4%. So with this being said, let's calculate the intrinsic value. As we see here, we get an annual return of 1.3%. So honestly, not looking too good for FICO. I personally think this company is overvalued. In looking at this, the P ratio is still very high. These are pretty high assumptions, especially for the valuation. So let's go over to the rankings. Looking at FICO, I think FICO might be the first company to go into the overvalued category. And the only reason for this is because I do think FICO is trading at a very high valuation, and there's slight concerns potentially over their moat in the future. Not saying that Equifax counterpart will take over FICO at all. I still think FICO will definitely be the leader in majority market share 100%, but we do have some concerns. So with that being said, I think the valuation looks a bit high. Now, the next company we're going to be looking at is Novo Nordisk. This company, if you don't know, is a drug company. I think one of the biggest drug companies behind Eli Lilly. And they actually make weight loss drugs. If you didn't know, they make Wegovy and Ozempic. So let's go over to my calculator to see whether or not we should be buying today. Taking a look here at Novo Nordisk, we actually get a pretty decent 7-step stock analysis. 6 out of the 7 key metrics are hit. The debt to free cash flow is the only thing that's not great, but it's not bad. 3.8, meaning they can pay off all their debt in less than 4 years. And the good thing here is looking at the 4P ratio of only 13, that looks very good. So let's go to the intrinsic value calculator and let's do the bearish case. So the thing with Novo Nordisk is there is slight concerns over how will the weight loss drug category look in the future and how will it grow. Obviously, in total, the weight loss category will be growing at a huge rate with the drugs. But the problem is, I think Novo Nordisk is going to be diluted. When I mean diluted, I think this industry will start to be diluted with a bunch of companies trying to get in on these weight loss drugs. So in the past, this company was growing at about 15% revenue growth. But I think in the future, bear case, that might be different. Bear case, let's do a 6% revenue growth. Base case, I'm going to do 9%, and bullish case, 12%. I think this company could still grow pretty decently. However, I do worry about the future with this company based on how much competition this industry may have. Now, for the profit margin, right now their profit margin is at 35%. However, I do think this is actually going to reduce at a pretty decent rate. And the only reason I think that is due to, once again, the amount of companies trying to create weight loss drugs, that's automatically going to reduce the price of these drugs, which will in turn reduce their profit margin. So bear case, I actually think we can get to a 28 profit margin. Base case 32, bullish case 36. Bull case, I'm still going to have it say it remains about where it is today, but I still think it will go down. Now for the shares outstanding, they've been buying back pretty decently, I think at about 1%. So I think bear case, let's do 1%, base case 1.5%, and then bullish case, let's say they buy back at 2%. Also, I forgot to do the P ratio, but PE ratio with Novo Nordisk, I don't think they deserve a huge premium just because of, once again, they don't have a huge moat over other companies, and I think the moat will deteriorate in the future, meaning their competitive advantage. Bear case with the company growing 6%, I think they deserve about a 16 P ratio. Base case, I'll do a 19 P ratio, bullish case 22. So with that being said, calculating our intrinsic value, we get an annual return of 14.9% for the base case for Novo Nordisk. If you think they can grow 9% in the future, this looks pretty good for Novo Nordisk. So that being said, I'm actually going to put Novo Nordisk into the buy now category, and I honestly think Novo Nordisk could be a buy now, but me personally, I don't love the future for Novo Nordisk, but it is looking very interesting. So I think I have to do some more research on Novo Nordisk to determine whether or not I should be buying this company. So honestly, I think Novo Nordisk could be a buy now if you take into the risk of the future and you understand the risks of how this might deteriorate from here with how the weight loss drugs will start to perform. So keep that in mind. Now, the next company we're going to be looking at is Uber. Taking a look here at Uber, we can see we have 4 out of the 7 key metrics hit. So one of the worst ones so far today. Forward P ratio looks pretty high at 42, but the trailing P ratio is actually in the teens. So keep that in mind. They expect their profit margin to really decrease in the future. Return on invested capital, 23%, very good. Revenue growth looks good. EPS growth is negative, which is interesting. Let's go over to the charts and see why that is. Oh, because the net income was negative. So they're actually growing very fast. So actually, this technically shouldn't be here. So keep that in mind. They're actually growing pretty well. So that's not a concern at all. Shares outstanding are increasing. So let's take a look at the shares outstanding. Yeah, they're increasing. That's the one thing I don't like about Uber, but they are a pretty good growing company. So it's not terrible that they're increasing shares. If they were a slow growing company, then I'd be really questioning why they're selling shares. But since they're fast growing, I think that's not bad. Now, debt to free cash flow 2.2, very low. This looks pretty good for Uber. So going to the intrinsic value calculator, keep in mind this profit margin at 26% is insanely high. I'm pretty sure there's a reason for this. Let's go and see why this is so high. Taking a look here, the profit margin just continues to increase, but there has to be a reason why analysts expect the profit to decrease in the future. So when I took a look into Uber, the reason why their PE ratio is so low and why the earnings per share actually went up so much and the profit margin is because of a sale of a security back, which is why the EPS was insanely high. So keep that in mind. This profit margin is actually a bit, when I mean a bit, it's very over exaggerated. In reality, their profit margin is probably 10-ish%. So keep that in mind with Uber. So with the revenue growth for bear case, I think Uber could probably go 7%. Bear case, base case, let's do 10%. Bullish case, 13% for Uber. I think Uber has a pretty bright future. As they start to partner with also companies like Waymo, which is self-driving, I think this could look good. So for the profit margin, like I said, I think their profit margin should be around 10 to 15%. 26% is an over-exaggeration. So with the profit margin, let's do a 10% profit margin bear case. Let's do base case, let's do 14%. Bullish case, let's do an 18% profit margin. Now for the future P ratio, I think company growing 7% probably deserves an 18 P ratio. Base case, I think Uber will deserve, let's do a 22 P ratio. In bullish case, I think they will deserve a 26 PE ratio. And shares outstanding are increasing, so keep that in mind. I think they'll increase 2%. Base case, I think they could increase 1%. And bull case, say they keep it constant. Now, for the intrinsic value calculator, we get a 1% return with Uber, which is actually very surprising with these low profit margins. But say we do increase this up to 20% profit margin. This is still pretty low compared to what it is today at 8%. I think Uber actually could be, I think, fair value to either overvalued, honestly. But if you think the profit margin should be greater than 15%, I think this company isn't good. So honestly, I think Uber could actually be overvalued right now. So with Uber, I'm going to put this into the overvalued category, which is actually surprising. But with that recent sale of a security, this makes it make sense why this company is overvalued. Now for the next company, the second to last company, we have Salesforce. Salesforce is a CRM business, the largest in the world. So basically what they do is just make it more efficient for other companies to manage their finances, to manage their workforce and stuff like that. Taking a look at Salesforce Salesforce, we get 6 out of the 7 key metrics. The only thing that's not great is the return on invested capital, and I'm pretty sure their growth rate is decelerating decently, so it's not growing as fast in the past. And the problem is this company, Salesforce, does have some slight problems with their moat in the future. A lot of companies are trying to become like Salesforce in that CRM business. So with that being said, going to the intrinsic value calculator, I think bear case, CRM, Salesforce will grow 6%. Base case, I'm going to do an 8% growth rate. Bullish case, 10%. I think they're going to grow high single digits. Future profit margin at right now it's at 16 to 17%. Bear case, I think it goes to 15%. Base case, I think we get to 18. Bullish case, 21. I think bear case, we see a lot more competition, so that's why I have it so low. Now for the future P ratio, I honestly don't mind these P ratios. Actually, let's put this base at 21 and then bullish case 24. Now for the shares outstanding, they're buying back at about 1% each year. So let's do 0.5% here. Base case, let's do 1%, and then bullish case, let's do 1.5%. So with this being said, I get a negative return with Salesforce in the future, and that's just what I get with Salesforce. Honestly, I don't like Salesforce. The only reason I don't like it is because I think in the future they're going to start to decelerate, and it's going to become a problem with Salesforce. Deceleration of growth, greater competition in that space. It just doesn't look great for Salesforce, and me personally, I'm not going to invest in this company. I think it's overvalued. So with Salesforce, we're going to put this also into the overvalued category with Uber and FICO. Now, the last company we're going to be looking at is UnitedHealth. This company has had a rough 2025, but Warren Buffett did just recently buy, which has helped the stock somewhat rebound. So with that being said, let's get into the last and final stock with UnitedHealth. Looking at UnitedHealth, we get 5 out of the 7 key metrics. The only 2 X's are the return on invested capital and EPS growth. The EPS growth is technically negative as of recently because of a problem that they've had in the past year. And this problem is basically with every health insurance company right now, a decrease in profit margin as a result of increased spending because they have had a lot higher medical costs, also because of their problem with pricing. So with that being said, for UnitedHealth, the revenue growth is still at 10-ish%. So with that being said, bear case, I think bear case, UnitedHealth deserves probably about let's do a 7% revenue growth rate. Base case 9%, bullish case 11. Now, for the profit margin, we see it's at 5%, right? However, in their recent quarter, they went down to about 3%. So keep that in mind with the profit margins. I think it will start to go higher in the future, but let's keep that in mind. So profit margin, I think bear case, it's at 3, let's do 3.5%, base case 4, and then bullish case 4.5. I think it's gonna take some time to get back to where they were at about 5%. I think it could take more than 5 years. So let's keep this base case at 4%. Future P ratio, company growing 7%. I think UnitedHealth deserves probably a 15 to 16 P ratio. This company isn't as high quality, and there's a lot of competition, but still, this company has a good moat still. 18 P ratio, bullish case 21. Now, for the shares outstanding, I think they're going to be buying back. Let's see how much they bought back. They bought back at about 1%, so let's just keep it here. And with that being said, looking at UnitedHealth, we get about a 9% return with UnitedHealth, and that's basically what I believe. I think this is market performing as of today's price at $350. But if it got back to in the low 200s like it was, that's a screaming buy to me. So let's go over to the final stock ranking. So with UnitedHealth, I'm actually going to put this into the undervalued category. So with that being said, we have Google, Meta, and Novo Nordisk in the buy now category. ASML, UnitedHealth, and undervalued. Fair valued, we have most of big tech with Microsoft, Amazon, Visa, and Alibaba. Then we have overvalued FICO, Uber, and Salesforce. So thank you guys for watching this video on this tier ranking. I know this was a very long video, so if you made it all the way here, I know you really liked it. So please subscribe and hit the like button. It doesn't cost anything to subscribe. It helps me and helps you to even learn more in the future. So please subscribe. And if you want to go check out that Patreon, just click somewhere right here. It should be over in the middle here. I hope I'm pointing at the right spot. It should be somewhere over there. So if you want to go check that out, click it. It's free for the first 7 days. You can get full access to my valuation investing website. So thank you guys for watching, and see ya.